Let's talk about it, because while the numbers were better than expected, fair to say that the tightening financial conditions have forced things to decline in many ways and made it a little bit harder to sell stuff. So where are we? We always sort of use you in a way as sort of a fascinating proxy for the global economy.
Andrew, it's great to be with you. I'll start with the quarter for us, which was pretty remarkable. Obviously, the market's backdrop was really tough, but we protected capital for our investors, and that's the key. We delivered outperformance. It's a function of the fact that we've been anticipating inflation for some time, and I think we've done a really nice job in sector selection. A lot of exposure to energy infrastructure, to travel-related businesses, to global logistics, to floating rate credit. That allowed us to outperform. That outperformance continues to lead to inflows. So we had $45 billion in the quarter, $183 billion year to date, a record for us over that period. And as you pointed out, the financial results, despite the challenges, very strong. Fee-related earnings up 51%. It is a much tougher environment. We should talk about that, but we're pleased with our performance.
Life is relative, and you're doing well on a relative basis to what is increasingly a tough environment out there. You've had to mark down the value of a lot of the assets. Just speak to, though, where you think we really are in terms of, I don't know if you want to call it a ball game, but what you think is happening in the economy.
So I guess I'd start by saying the Fed, I believe, is beginning to have success on its goal to slow the economy and slow inflation. At the same time, there's still a fair amount of momentum in both. If you think about what's going on, think about the Fed almost as the doctor administering a shot to the arm of the economy, basically trying to slow things down. The immediate impact has been in capital markets. Stocks have gone down by 20+% this year, bonds by 15+%. Credit markets have tightened a lot. That's begun to move to sort of the rest of the economy, starting with the capital side of the economy. So the good side slowing. We're seeing container shipping slow down in our portfolio. The furniture business is slowing. The for-sale housing business, when you have 7% mortgage rates, that starts to slow down. Now, as you move deeper into the economy, you still see a lot of strength, as I mentioned, in travel. Unemployment today is still only 3.5%. But when you talk to our companies, what you're seeing is they're becoming more cautious on their hiring plans. They're thinking about spending less in terms of CapEx. And so you can feel things start to slow. And the Fed policy does work with a lag. I was talking this week with a very large apartment developer who has 15,000 units under construction. His budget 6 months ago was to do another 15,000 units in 2023. He has now shelved 75% of those units. And so when you think about the workers there, unfortunately, next year is going to look a lot tougher. So I would say the slowdown is working its way through the system, but it takes time.